Hey YouTube, it's Dimitri, and today I'm going to talk a bit about the Dodd Frank Act. It's called like the Dodd Frank Wall Street Reform, whatever Act. But it's been a big kind of topic lately as Donald Trump got elected as president. There's been a lot of talk about dismantling Dodd Frank Act. And so I was going to kind of break down some of the basics from someone who actually works in banking and not just someone who's opinionated and doesn't really do this for a living. So to start off with, the Dodd Frank Act is just massive. I'm not sure if anyone's actually looked at it. I know people that passed it had no clue what was going on. The bill itself, I think, is like 1,800 pages or so. I downloaded it in college and looked at it, and it's massive. I had it in a PDF. I read, I think, to like 20 pages of nonsense and was like, this is too much. Anyways, but more or less, there are many, many pieces of this bill that are more or less supposed to prevent a financial crisis or at least help alleviate issues that occur. And I can tell you from working in banking, as my opinion, I do not represent any bank or any institution or any group. Just as a personal opinion, I don't think it will do of any good. But let me follow that up with there are some good parts that have came out of it, but it will not prevent a financial crisis. So the biggest piece of Dodd-Frank that I'd actually work with is what we call DFAST, which is the Dodd Frank Act stress testing, which is for smaller banks. And smaller, I mean over $10 billion in assets, which is still pretty large. And then banks that are over, I think it's like 50 billion in assets. They are subject to CCAR, which is like a capital comprehension assessment of risk, something like that. Anyways, so CCAR is for big banks, DFAST is for little banks. More or less, they're stress testing. And so for those of you that don't know what stress testing is, it is more or less you have a bunch of assets on a book. So say like a bank has a bunch of different assets. It has loans it makes to consumers. It has credit cards it makes profits off of. If there's any trading books, like risk management, derivative products, basic accounting, assets, liabilities, things that are held on the books, we typically have to model all those. And so what they do is you build a model and you want to predict, for example, let's say like home assets on the book that the bank holds. And so you want to model this through time, but you want to do stress testing. So the stress testing is where you have different scenarios. The Fed will give you 3 scenarios which they project. So it's pretty arbitrary on the fact that somebody chooses the scenario and they have all the variables and they predict the variable and say, okay, if the economy is what we expect it to be, we'll call this the baseline, and GDP will do this over the next 9 quarters, unemployment will do this, and then they lay them out. And that's the base case or base scenario. Then they have an adverse scenario, which is like, it's not expected, it's worse than expected, but it's in the middle. And then you'll finally have the bottom one, which is severely adverse. So if, I don't know, another crisis hits, what do we expect is going to hit with unemployment, with GDP, with housing prices? There's a whole bunch of variables that go into this, and the Fed predicts these different scenarios, and then you actually take these variables, so like GDP, unemployment, house pricing, all that, interest rates, you plug those into the models you built that's built on your bank's portfolio, and then you see more or less how you handle the scenario. And so depending on what you're modeling, so for example, if you're modeling like mortgage on the book for the bank, if you had a crisis like that of 2009, 2008, the whole financial crisis, you'll see like, for example, that assets on the book for mortgages will actually spike because a lot of people defaulted on homes. And so the bank got stuck with all these houses. They try to dump them. They try to get rid of them. But more or less, it's a liability and an asset. The bank still has to maintain that property before it can sell it. And so anyways, we're trying to model this over time, and this is stress testing. I do agree. I think it's a good idea they have DFAST and CCAR. So there's minor regulations for smaller banks, and then there's more strict regulations for larger banks. However, I'm not sure the impact this actually has on banks. I know banks have been complaining a lot. Every bank all across America, they're complaining, they're lobbying, they want less regulation. And somewhat it makes sense. It's very, very, very expensive to do CCAR and DFAST. You have to hire a bunch of people. They can build models. This means you hire people with masters and PhDs. They require more income than somebody who has like a bachelor's degree. You're typically hiring very quantitative people such as myself. And at the end of the day, it gets very competitive to get better people to build better models. And I can tell you from experience, one modeler is not worth the same as another modeler. A very good modeler can be worth easily 5-10 times a garbage modeler because they build better models that don't need to be redeveloped over time. And they can build more models quicker. So those are different advantages. However, a lot of parts of Dodd Frank, this whole thing, is it's so big, there's so many details. It's trying to more or less prevent banks from banking because they want to reduce every risk possible. And so I think this is complete garbage. It should not be 1,800 pages. It shouldn't be that, a licensed lawyer, professional, someone who works in financial law can't understand it or has to spend months and months and months digging through this to figure out what's going on. They're going to pass regulation. I think Dodd Frank should be revised. It should be simplified, and it should be something very, very small. It should have common sense laws. And again, I think this is a knee-jerk reaction. We had a financial crisis. We want to blame it on somebody. We blame it on the banks. And then we run out and we create some just crazy, more or less, reform, some bills and stuff. We're going to force the banks to do what the government wants or the people want. And yet we don't really understand banks because they don't work in banking. They don't understand banking. But on the flip side, I do think there are some positives that have come out of this. A few of those positives have been risk as a culture. So banking pre-1980s, 1990s, 2000, it's been mainly business people. You have an MBA, you have a bachelor's in business, a BBA. And so you run finance more or less in a financial sense of the money coming in, money going out. You use accounting, you use basic finance. You find customers, you make loans. And more or less, that's banking. The problem is when derivatives were introduced, and Fisher-Black more or less solved the closed-form solution to the Black-Scholes, which I know is not a perfect solution, but more or less we discovered how to price options efficiently, or more efficiently, is that banking got complicated. And so you would assume, and I'm sure the American public stands there and says, oh, these are banks, they're really smart people, they're going out, they're looking at, the risk and return. Why would you take on a bunch of risk if you're not going to get compensated for enough return? However, risk isn't really understood that well. And I think the Dodd-Frank and the CCAR stress testing and DFAST that we do has changed that somewhat. It's bringing in more or less quantitative people that understand risk from a mathematical perspective, people that can digest a lot of the complexities that people with a business degree just can't do. They don't have the skill set to do it. And I'm not saying that's all of them, but the majority of them don't have the amount of statistics, mathematics, and computer programming required. If you're using Excel, you probably have no clue what you're doing when it comes to modeling. But again, it's helped to bring up this point. It's helped to come back and say, we need to look at risk as a whole bank, for example. Like we were doing it in silos. Like you had market risk, credit risk, ops risk, PPNR. It doesn't make any sense. And the Fed's been pushing more or less to have like an enterprise-wide realm of risk. Like we need to look at this as a whole picture because one operational risk could cause, a market risk, which then could default in a credit risk, and we'd have a lot bigger problem than we had in the past. I can tell you banks still don't really understand exactly how much risk they have. There's been a lot of great models built. Banks have actually done a pretty good job in general at analyzing risk, but looking at risk from a whole corporate level takes more quantitative skill. And so I understand on the bank on the flip side, which is we don't want to pay, a good portion way into six-figure salaries to hire one person. So a lot of them try to take, different methods for hiring not so qualified people, or just saying a PhD is a PhD and a master's is a master's, and we just hired a bunch of people. But again, I encourage banks should be investing more money in people and hire less people. And at the end of the day, you should spend less money on your analytics divisions and your risk management. However, you should be trying to understand this more deeply. And I think academia is doing a decent part at this, kind of adding more research as we're going. But again, I think it's helped. DFAST has helped in the fact that banks are starting to analyze this more from a risk perspective. They're starting to realize, I'm Tom, I'm some little banker, I make loans. you know, it's not just you. Like, you make a large impact. You could make 100 bad loans, which could then affect somebody else. And if somebody else is also doing the same strategy you're doing, this could compile and the bank could go bankrupt because loans all default because maybe, I don't know, housing, the market crashes, or the auto market crashes, or I don't know, something crazy happens, GDP drops for some reason, unemployment's going crazy. These are all possibilities. But again, I think the risk perspective that it's driving home even to the people on the very bottom that are actually making loans, you're understanding how you impact more or less the bottom line of risk across the bank. People in positions, for example, like executives, CFOs, all the way down to like mid-level managers, and again, to the people that are actually making loans and doing a lot of the work. I think it's doing a good job at raising awareness of the risk. However, in conclusion, I feel like Dodd Frank should definitely be cut back. It should be fixed. It should be made more simple. It should be something that everyone can understand, with the realization that government does not solve problems. Government creates more expenses, more bureaucracy. You can't force people to do the right thing. You can attempt to do it, but it will result in bad results. And so I think Dodd Frank Act in general, including the CCAR and all that, should be limited to something logical and reasonable, with the assumption that banks are going to do what banks are going to do, and you can't control them. So those are my opinions on Dodd Frank Act, DFAST, CCAR. Again, I didn't even touch like 99.9% of the Dodd Frank Act. There's a lot of stuff like the Glass-Steagall Act, which has to do with proprietary trading. And again, it's not called Glass-Steagall in Dodd-Frank, but it's a similar concept. Banks can't do proprietary trading. I'm not going to get onto my opinion whether I'm for it or against it. But again, there are lots and lots of parts to this, and this really does need to be revised. For those of you out there saying, oh, let's just crash all of it, let's just scrap it, let's just make a bunch of money in banking, as some banks are doing and some people are thinking, I think this, again, is a knee-jerk reaction in the opposite direction, which is instead of having a whole bunch of regulation, we're going to having like no regulation. And again, there are positives. We need to be thinking about risk as a company-wide, as banks. This also should be considered for corporations, not just banks. But those are kind of my opinions. What do you guys think? Are you for keeping Dodd-Frank? Are you for getting rid of it? Or are you more like me in the middle, where it definitely needs revision? We can help banks cut a lot of the expenses they've had to incur from this, while also maintaining a good risk culture and kind of monitoring risk from a banking perspective. So anyways, thanks for watching, and as always, until next time. Thanks for watching my video. If you find it helpful, please like, share, and subscribe.